The ever-increasing threat of cybersecurity attacks has made the business behind cybersecurity software an attractive and lucrative investment for investors. The most pernicious of these ransomware attacks force businesses to pay hackers millions in ransom to get their systems back online, while generally costing the victims of these attacks billions. With more of our lives and information being stored online, cybersecurity firms are essential, and our goal is to invest in the best. Welcome to the Quality Investor. Notable incidents in 2024 include Change Healthcare, a subsidiary of United Health Group, which had a breach of its medical claims processing system and forcing patients to pay out of pocket and costing UNH billions. Snowflake faced a data breach affecting over 100 of its clients' sensitive information. In 2023, MGM Resorts in Las Vegas had its casino operations crippled for days while under a cybersecurity attack. Slot machines went offline, sportsbooks were shuttered, and transactions were recorded via pen and paper methods. This cost MGM over $100 million, yet MGM refused to pay the hackers. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. All of this highlights the importance of firms within the cybersecurity industry. Personal data is incredibly valuable, and securing that data is more important than ever. The industry market size was reportedly $245.6 billion in 2024 and is expected to grow significantly in the coming years at about 12.9% annually through 2030. As more businesses embrace cloud platforms, ransomware attacks become more sophisticated. And as AI becomes more ubiquitous, exposure to this industry can lead to outsized returns in our investment portfolios. These attacks are evolving at lightning speed, and this means cybersecurity providers must stay on the cutting edge to provide adequate defense. When focusing on investments in this industry, firms with deep industry knowledge and experience, significant capital resources, and a track record of innovation will emerge as winners. Last week, one of the industry's top players released their fiscal year 2024 earnings. Fortinet had an excellent earnings report showing incredible strength across the board. And before diving into the details, I want to quickly discuss why Fortinet is a strong investment. Fortinet has a comprehensive ecosystem of offerings, providing hardware for network security and other on-prem solutions, but also software services designed to detect threats, secure cloud environments, and protect remote workforces. This holistic approach creates a network effect as each offering reinforces the value of other offerings. Fortinet has invested its capital aggressively in recent years in AI and machine learning technology. This is oriented toward detecting the growing complexity of threats as well as offering rapid and nimble responses to said threats. Fortinet has been leveraging AI for nearly a decade, which provides them with a strong head start among competitors along with high barriers to entry, since the capital resources necessary to develop AI expertise are significant. Businesses that can leverage AI going forward to enhance cybersecurity will have an advantage in the market. All of this is integrated in Fortinet's products, again reinforcing its network effect and providing Fortinet with strong switching cost protections. The highly integrated and holistic nature of Fortinet's services make it difficult to switch to a competitor once implemented. Demand for cybersecurity solutions is on the rise at the enterprise level, with sectors vital to national security, such as government, banking, and telecom, seeing the highest demand growth. It is also becoming increasingly important at the consumer level. Consumer cybersecurity is expected to grow faster and take overall market share from the enterprise level. This is primarily driven by the Internet of Things, or smart device connectivity. Smart devices and gadgets have proliferated with households and are all connected to wireless networks and routers. Fortinet is instrumental in protecting these networks and firewalls. All of this has made Fortinet a premier business in the cybersecurity industry and attractive to investors. But Fortinet has done something else that will boost their long-term prospects even further. Fortinet initially started with hardware solutions for cybersecurity. Yet the market has shifted towards software-based solutions as cloud computing has become more prevalent. Fortinet has strategically pivoted towards this development by focusing more on providing software and cloud-based solutions. This shift has boosted the profitability of Fortinet considerably. As we're about to see, this is a main driver of Fortinet's nearly 60% one-year share price appreciation. But does this mean that Fortinet is still trading at an attractive price? Let's dive into the earnings and assess what a fair value of this cybersecurity leader actually is. Fortinet's earnings demonstrate another year of solid growth. Nearly $6 billion in revenue, which was a 12.3% increase from 2023. And the services segment, the segment that's driving growth for Fortinet and has by far the highest gross margin of both of the segments, had $4.05 billion in revenue, which was a nearly 20% increase from 2023. The overall gross margin for Fortinet was at 80% in 2024. Yet the service segment recorded an 87.5% gross margin. That's an increase from 86% in 2023, or 150 basis point increase. The expanding margins, like I mentioned in the outset, are what's driving value creation for Fortinet. There are two more bullet points I want to highlight here, both of which Wall Street really likes to pay attention to. Earlier in the year, Fortinet posted an earnings, I don't remember it's Q1 or Q2, where they had a pretty drastic fall in the market because they posted a decline in billings. When you have a subscription-based business, the billings are sort of like the run rate. You want to see an increase in billings. That means that your subscriptions are going up. So the $6.53 billion in 2024 for billings, which is a 2.1% increase of $6.4 billion in billings in 2023. And the other important bullet point here is deferred revenue. This sort of ties into the billings. Deferred revenue is revenue that will be recorded once Fortinet has met their obligation to their client. So you can think of it as contractual. And they have a deferred revenue of $6.36 billion, which is an increase of almost 11% compared to the $5.74 billion in 2023. Wall Street pays very close attention to those two numbers. Fortinet closed out the day at $109.55. And you can see this weird trend line in their 5-day chart here. You see the big pop right after earnings, but they gave it all back throughout the day, but they've been steadily increasing ever since. In the past 5 days, they are up 8.5%. Year to date, Fortinet is up 15.6%, off to a very strong start in 2025. Overall, the market was initially excited about Fortinet's earnings before giving most of that back throughout the day. But what I'm always looking for on every single earnings report is that free cash flow increasing. And yet again, Fortinet posted very strong growth here. $380 million in free cash flow in the most recent quarter. That's a 130% increase from the $164.8 million in Q4 of 2023. But on the year, Fortinet posted $1.88 billion in free cash flow, a very solid increase of 8.5% over the prior year of $1.73 billion. Fortinet's overall growth in all the important metrics is just very impressive. Steady, consistent growth. Over the last 10 years, they've grown their revenue by 22.7%. Free cash flow has grown 27.6% over the last 10 years. It has slowed down a bit, I will grant you that, but we're still seeing cash flow compounding year after year. But you notice they're also investing more in capital expenditure. These are investments into securing Fortinet's place in the market as a leading cybersecurity firm, especially in the world of AI. So while free cash flow growth is slowing, to me it's slowing for a good reason. To me, CapEx is not necessarily a bad expense per se. As long as a company can manage their capital investment well, I do know in the long run it will pay off. And here's an example of what I mean by that. Here you can see the very good, steady gross margin growth and operating margin growth over time. This is due to that shift towards the services segment, which is far more profitable for Fortinet than their products services are. Roughly 2/3 of their revenue now comes from services. But you can also see that growth in ROIC, or return on invested capital, how the company's managing the capital they're investing back into the business. It hit a bit of a high in 2023 at 185%, but of course now it's back down to reality a little bit at 24.39%. But you can see it's trending upwards since fiscal year 2015 when it was at 1%. ROCE, return on capital employed, is even better at 39.6% at the end of fiscal year 2024. So now, given the run-up we've seen for Fortinet up to $109.55 in the market, almost a 16% year-to-date gain, what sort of fair value is Fortinet trading at? Is it a buy right now at that $109? Well, my year 10 estimate for operating margins at 35%, modest growth from the 31.5% I'm projecting in year 1, net margin expanding to about 30% by year 10, and free cash flow margin expanding to 40% by year 10. I estimate they are repurchasing about 1% of their shares. And you can see I'm projecting 11.4% year-over-year revenue growth. A bit of a slowdown from the 12.27% we saw last year. And I am projecting it to slow down, of course, going forward throughout the next 10 years. They'll ultimately give us a compound annual growth rate of 9.5%. I'm expecting operating income to grow about 11.1% over the next 10 years. And ultimately, free cash flow I have growing at about 12.35% over the next 10 years. You can see that would be a considerable slowdown in growth that we have experienced over the last 10 years historically. So given those growth assumptions here, what can we expect to pay for Fortinet and still expect a nice return in the future? Well, like I said, they closed at $109.55. The PE ratio is at 48.5, below their 5 and 10 year average. But to me, this is more of a PE ratio that's normalizing back down to the industry norm. The forward PE is at 47.6, which is actually slightly above their 5-year average. On a discounted cash flow basis, their bear price is at $79.97. That is based on revenue growth of only 7.4% and a free cash flow margin 10 years from now at 33.8%. The base case, like I showed you, was at $109.65 based on that 9.5% revenue growth and a 40.64% free cash flow margin. And a bull case, and a lot of analysts are projecting very good growth, especially in the services segment for Fortinet into the future here. A bull case price of $154.39. That's based on 12% revenue growth and a free cash flow margin of 47.9% by year 10. The exit multiple is actually at $106.22, which is based on comps of Palo Alto Networks, CrowdStrike Holdings, VMware, Block, Qualys, Datadog, Juniper Networks, and F5. Those businesses collectively have a median PE of 47. So you can see with the recent run-up in the market here, even our base case now is a little bit overvalued. There's about a 1% downside based on the $108.45 average. There is some upside on the bull case, $137.53, at about 25% upside there. But with no margin of safety, that gives us a buy price of $110.90. Of course, we in the quality investor must have a margin of safety. And for Fortinet, I like to use a 20% margin of safety. It is in a very leading edge industry with many other great businesses competing, not necessarily within Fortinet's niche, but with a 20% margin of safety. It's a buy price of $88.72, or a forward PE of 38.2. So I think at this point, Fortinet, as much as I've enjoyed seeing them run up in my own portfolio, I'm not going to be adding any shares anytime soon. I want to see them come back down under $90 before I'm willing to add more to my portfolio. And this is a position I would love to add more in. I actually really believe this is a strong business and will provide many years of growth to come, not just in the market, but in my portfolio as well. But I think it's a little bit high of a price right now, and I would want it to come back down a little bit more to under $90 before I'm willing to add to my current position. That said, we'll see how they grow in 2025. If they hit some of the analyst projections over the next couple quarters, that would certainly boost up my own valuation here if they're projecting considerably higher than what my base case projections are. And at that point, we could see this stock running up even more, and it would probably be a very good stock to add to. But I definitely want to wait and see the results before doing that in my own portfolio. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.